So here's a question for you. Is investing really as hard as all the experts on TV make it sound? Today, we are going to dig into a book that threw a bomb into the entire financial industry with one simple, radical idea. That when it comes to picking stocks, the pros, well, they might not have any edge at all. You gotta love Mark Twain for this one. I mean, he's obviously joking, but he's making a point that is just as true today as it was 100 years ago. Trying to predict the market's every little move, it's a fool's game. This quote, it just perfectly sets the stage for everything we're about to unpack. All right, let's jump straight into the book's most famous, and let's be honest, most provocative idea. What if all those highly paid experts on Wall Street, with their fancy degrees and supercomputers, what if they're no better at picking winning stocks than just pure random luck? And that leads us to this amazing thought experiment. I mean, it sounds completely ridiculous, right? A blindfolded monkey throwing darts versus a Wall Street genius. But listen, this isn't just some funny image. It's a very serious challenge to the entire multi-billion-dollar industry built on the idea that experts know best. Okay, so this whole idea is built on something called the random walk theory. Here's the best way to think about it. All the stuff we know about a company, the news, its earnings reports, everything, it's already baked into the stock's current price. So the only thing that can make the price change tomorrow is new information, which by definition is unpredictable. This means short-term stock movements are basically as random as a coin flip. And that classic phrase, past performance is no guarantee of future results, yeah, this is exactly why. So if we can't really predict the market, how in the world do people decide what to buy or sell? Well, it turns out that pretty much every investment strategy falls into one of two buckets. It's like two warring tribes with completely different beliefs about how the world works. And here's that clash right here. On one side, you have the firm foundation folks. Think of them as detectives. They're digging through financial reports, trying to figure out a stock's one true value. Then, on the other side, you've got the castle-in-the-air crowd. They could not care less about intrinsic value. Their whole game is about guessing what other people will pay for a stock tomorrow. It's all about finding a greater fool to sell to. So you see, it's a total battle between cold, hard logic and human psychology. And you can probably guess what happens when that castle-in-the-air thinking completely takes over the market, when human psychology just runs wild. Well, history is filled with cautionary tales, and believe me, the results are almost always a disaster. This quote from way back in the 19th century, wow, it just nails it. Gustave Le Bon figured out that when people get together in a crowd, they don't get smarter. Actually, the opposite happens. It's the perfect way to understand the story of speculative bubbles. And this is not some rare once-in-a-century thing. Look at this timeline of pure madness. In the 1600s, people were paying more for a single tulip bulb than for a house. In the 1700s, a company with basically zero profits saw its stock soar. Then you have the 1920s crash and, of course, the dot-com bubble in 2000, where any company with a dot-com in its name was suddenly a billion-dollar superstar. The details change, but that human behavior underneath, that fear of missing out, that greed, it's always the same story. Let's just zoom in on one of these for a second. The South Sea Company. Look at these numbers. The stock price exploded by almost 800% in just 8 months, fueled by nothing but pure hype and speculation. And then, pop. In a single month, it all came crashing down, wiping out countless fortunes. That's your castle in the air, turning into a pile of rubble. Okay, so we've seen that trying to outsmart the market is, probably a losing game. And getting swept up in these speculative manias is just plain dangerous. So what do? What's the alternative? Is there a simpler, smarter way to do this? This right here is the statistical knockout punch. Study after study confirms it. Over any meaningful stretch of time, most of the pros, the people who get paid huge salaries to pick stocks, they actually fail to beat the market. They don't even match the performance of a boring, unmanaged index like the S&P 500. And that simple fact leads to this beautifully simple question. If most of the experts can't beat the average, why try? What if you just stopped trying to find the needle in the haystack and just bought the whole haystack? What if you owned a tiny piece of every big company out there? And what does that actually look like in real money? Well, here you go. Over a 45-year period, a simple $10,000 investment in an index fund would have made you almost $250,000 more than if you'd put it in an average, actively managed fund. That's a staggering amount of money just lost to fees and the cost of trying to be clever. And this chart just makes it crystal clear. That shorter bar, that's what you get on average from trying to beat the market. And that much taller bar, that's what you get from just buying the market and patiently holding on. The evidence is just overwhelming. Over the long haul, the simple, boring, low-cost way wins. It wins by a lot. All right, so this has all been fascinating theory, but the big question is, how do you actually use this in real life? So let's wrap this up by turning all these big ideas into a simple, practical 5-step plan you can actually follow. Let's walk through this. First, you get your financial house in order. Start saving, like right now, so the magic of compounding has time to work. And build a cash safety net so you never have to sell your investments at a bad time. Second, the main event. Buy the whole market using cheap index funds. Third, put the whole thing on autopilot. Set up automatic contributions so you're investing consistently without letting your emotions get in the way. And finally, just check in once a year to rebalance and make sure your plan is still on track. That's it. It's a simple, repeatable, and incredibly powerful process. And we're going to end with this just incredibly humbling quote from Sir Isaac Newton, literally one of the smartest people who ever lived. He lost a fortune in that same South Sea bubble we talked about. And it's the perfect final reminder that investing isn't really a math problem. It's a behavior problem. And maybe, just maybe, the real challenge isn't about being smart enough to outwit the market, but being disciplined enough to conquer the madness inside ourselves.